Okay, it's that time of year again. Tax season in Singapore. And yeah, it can feel a little overwhelming, right? But what if I told you that Singapore's system is actually one of the friendliest in the world for employees? Seriously. In this explainer, we're going to break it all down so you can file with total confidence and, more importantly, make sure you're not leaving any money on the table.
So here's the game plan. We're going to start with the absolute most important thing, your residency status. Then we'll get into the nitty-gritty of the tax rates themselves. After that, the fun part, how to legally lower your tax bill. We'll spotlight the biggest reliefs you need to know about and finish up with some simple tips to avoid common mistakes. All right, let's dive right in. First up, residency. Seriously, before you even think about numbers or deductions, this is the master key. Your residency status pretty much decides everything about your taxes here in Singapore. It is the critical first step.
So you've got to ask yourself this one simple question. Are you a Singapore tax resident? Because the answer, yes or no, sends you down two completely different roads.
So how do you know? Well, it's pretty straightforward. If you're a Singapore citizen or PR living here, boom, you're a tax resident. Easy. For everyone else, the big one to know is the 183-day rule. Basically, if you physically stayed or worked in Singapore for 183 days or more last year, you qualify. The other rules are just there to cover folks in more unique, longer-term work situations.
And believe me, this distinction is huge. Why? Because as a resident, you get access to progressive tax rates. We'll talk more about those, but they start at 0%. Plus, you get to claim all these juicy tax reliefs that shrink your bill. But as a non-resident, you're looking at a flat, often much higher tax rate and no reliefs. We're talking a difference that could literally be thousands of dollars. Okay, so let's say you figured it out. You're a tax resident. Awesome. Now, how does IRS actually figure out how much you owe? Well, that all comes down to the tax rates. Now, Singapore has what's called a progressive tax system for residents, and this is super important to understand. It does not mean your whole salary gets hit with one high tax rate. Not at all. A better way to think about it is like this. Your income is split into different buckets. The first bucket is taxed at a very low rate, or even zero, and only when you fill that bucket up do you move to the next one, which has a slightly higher rate, and so on. And here's what those buckets look like in real life. Check out that first line. The first $20,000 you earn is taxed at 0%. You heard that right, it's completely tax-free. Then the next chunk of your income gets taxed at a tiny 2%. The next at 3.5%, and it just keeps climbing gently from there. The rates only really start to climb as your income grows, all the way up to 24% for folks earning over $1 million a year. Okay, now let's compare that to the non-resident rates. It's way simpler, sure, but it's usually way more expensive. Your employment income gets hit with a flat 15% right off the bat. There's no 0% bucket to enjoy, and you can't claim any reliefs to bring that number down. Oh, and there's a little bit of good news for all you tax residents this year. The government's giving out a personal income tax rebate. And the best part? It's totally automatic. You don't have to lift a finger. IRS just does it for you. So what is it? It's a 60% rebate on whatever tax you owe. Now, it is capped at $200, but hey, that's still a direct discount on your final tax bill. We'll take it. All right, now we get to the really good stuff. This is the part you've probably been waiting for. It's all about strategy. We're talking about all the perfectly legal, government-approved ways you can actively shrink your taxable income and in turn shrink your tax bill. But hold on. Before we go crazy claiming every relief under the sun, there's one really important number you need to know. The government has a cap on the total amount of personal reliefs you can claim in a year, and that magic number is $80,000. Now look, most of us probably won't get near that limit, but it's something you've got to keep in the back of your mind. So the good news is, you're likely already getting a few tax breaks without doing a thing. IRS handles some of them for you automatically. Things like the Earned Income Relief. You get that just for working. And relief for your mandatory CPF contributions. You know, that money that goes into your retirement fund. And of course, there are reliefs for NS men as well to thank them for their service. But if you want to get really smart about your taxes, you've got to be proactive. And two of the most powerful ways to do that are by voluntarily topping up your CPF or contributing to your SRS. That's the Supplementary Retirement Scheme. Think of these as a fantastic 2-for-1 deal. You get a nice big tax deduction right now, and you're also pumping up your retirement savings for the future. It's a win-win. Okay, so let's zoom in on some of the biggest reliefs that you probably have to claim yourself. And this is where you need to pay attention, because the big question is, Are you accidentally leaving money on the table?
Let's start with parent relief. This one is huge, and so many people miss it. Here's the deal. If you're supporting a parent or even a grandparent, and their own income is less than $4,000 a year, you can claim this. You get more if they live with you, which is great. Just one catch. Only one of you kids can claim for each parent, so you'll need to have a quick chat with your siblings to decide who gets it.
And for all the parents out there, these next reliefs can be a total game changer. So you've got your standard child relief for each kid, but, and this is a big but, working moms can also claim the working mother's child relief on top of that. It's a percentage of your income, and being able to stack these two together can make a massive dent in your tax bill.
Okay, listen up. This next one is super time sensitive. If you took any courses last year to upgrade your skills for work, you can claim up to $5,500 for those fees. But here's the kicker. This is the last call. This relief is being removed starting from the next tax year. So if you're eligible, you absolutely have to claim it now or you'll lose the chance forever.
Get ready for a number that's going to blow your mind. 250%. What's that about? Well, when you donate to an approved charity here, the government gives you a massive thank you. You get a 250% tax deduction. Let me break that down. For every $100 you donate, you get to reduce your taxable income by $250. It's an incredibly powerful way to do good and save on tax.
All right, we're on the home stretch. Let's talk about actually filing your taxes. You're armed with all this info now, so you should be feeling pretty good. But to make sure everything goes off without a hitch, let's quickly cover a few common mistakes so you can totally avoid them.
Okay, here's your 5-step checklist for a perfect filing. Number 1, if IRS sends you that letter or notification, you have to file. No excuses. 2, declare all your income, not just your main salary. Think side hustles, freelance work, whatever. 3, double-check that you actually qualify for the reliefs you're claiming. Don't just tick the box. 4, just because some info is auto-filled doesn't mean it's perfect. Give it a quick once-over. And 5, keep your paperwork, your receipts, your statements for 5 years, just in case.
So let's do a super quick recap. What are the biggest things to remember? First, your residency status is everything. It changes the whole game. Second, hunt down every single relief you're entitled to. Just remember that $80,000 overall cap. Third, donating to an approved charity gets you that insane 250% deduction. And last but not least, get it all done accurately and on time. The deadline is April 18th.
And there you have it. You've got the tools, you've got the knowledge, you are ready to tackle your income taxes with confidence. So I'll leave you with this one question to think about. Armed with everything you just learned, which tax relief are you going to claim for the very first time this year?